What's up, investors of the internet? My name is Chris Patel. Today, we're going to talk about which stock you should buy.
Welcome to the Unbiased Advisor Podcast, where we explore investment themes and insights for investors and financial advisors alike. The views expressed are intended solely for informational purposes and should not be construed as investment advice and are not meant to be a solicitation or recommendation to buy, sell, or hold any securities mentioned. Please stay tuned for additional disclosures at the end of the podcast.
What stock should I buy? That's usually the first question I get when people find out I'm a financial advisor. So with this video series, I hope to give you some insight on how I think about that question and what I do to try and figure out which stock should I buy. So the first thing to understand in finance or in investing in general is that there's no such thing as a free lunch. Essentially what that means is if you want to earn a return greater than the risk-free rate, you have to take on some type of risk. And when you invest in stocks, that risk comes in two forms. One is known as systematic risk, and the other is unsystematic risk. Well, unsystematic risk is the risk associated with that particular stock, or in this case, company, because when you buy an individual stock, what you're actually doing is buying ownership in a company. And the risks associated with that company have to do with profit margins, revenues, execution of management, supply chain issues, things of that nature. So what you want in a company is to execute on those. You want high profit margins, high revenue, high growth rates, low risk, that type of things. So that's typically what we think about when we think about buying individual stocks, is the unsystematic risk associated with that stock. Will that company execute on what they're trying to accomplish? The other type of risk is what's known as systematic risk. And this is the risk of just being part of the overall stock market. And one way to think about this is like a house in a neighborhood. Think of a neighborhood where all the houses are essentially built the same. So they all roughly have the same amount of rooms, the same amount of square footage, and they're obviously in a neighborhood. So systematic risk is, let's say a couple of those houses are infested with termites. And so realtors across the nation or in your area kind of figure out that, hey, this neighborhood has some termite infestations. Well, the prices of those houses will actually come down because people or the buyers that want to buy those houses are going to be worried about that house being infested with termites. That's what's systematic risk. The value of your home is coming down simply because it's in that neighborhood. And just like the stock market, stocks will come down even if the company is executing on their goals, increasing profit margins, increasing revenues. Their stock price still might be affected in general with what's happening with the overall stock market. That's systematic risk. Unsystematic risk would be if I owned a house in that neighborhood and perhaps there was a fire in my backyard and, a portion of my house caught on fire. So that obviously is specific to that house. And so the value of my house in that case would go down. So those are the two main types of risks you need to be aware of. Again, you have systematic risk, which is just your house being in the neighborhood, right? If the stock market is doing well, in general, the price of your stock is probably going to do well. It might not do as well relative to others, or it might not do as bad relative to others. But just the fact that it's part of this market, or in my example, part of the neighborhood, the price of that stock is going to fluctuate. And then there's unsystematic risk. Again, going back to the execution of the management team, the profit margins, the revenues. If there's any kind of missteps by the management, or there was some extenuating circumstance that maybe disrupted the supply chain of that company, and so we couldn't maybe get out the products that we want to sell to people, or just expenses kind of skyrocketed, so our profit margins came down. That's unsystematic risk. That's risk associated particularly with that one company and therefore that stock price. So now that we understand the concepts, or at least the two main concepts of risk associated with individual stocks, the next thing to understand is how the value of a stock happens. So really there's two components that are happening whenever you're talking about pricing of stocks. And I just kind of said both the words that you need to pay attention to: price versus value. So most people think these two words are interchangeable, but when you think about investing, they're actually two separate concepts. So you have pricing and you also have what's called value. So pricing is primarily driven by supply and demand metrics in the market. So just like with any type of good that you would buy or service you would buy, you have a certain amount of demand for those goods and services, and you have a certain supply of those goods and services. And when you interchange both of those demand curves and supply curves on each other, that's where you come up with a price of a security or a price of a service or a price of a good. And just like with anything else, if the supply of something goes up, the price is going to come down. If the demand of something goes up, the price is going to go up. There are meme stocks out there where the demand kind of shoots up, where a bunch of investors kind of jump on board with certain stocks or certain sectors and drive the price up. That's not necessarily because that particular company is doing well, but now the demand curve is shifted. And so the price of that stock is going to start to increase. Conversely, there might be some news or something that comes out about a stock or some rumor that comes out about a company. And so now you have a bunch of people not demanding that stock. So the demand curve kind of shifts down. And so the price is going to come down in that instance. So that's what pricing is. And pricing is usually driven in the short run. And a lot of it has to do what I call with sentiment. So sentiment is like, how do I feel about this company? You will come across portions in the market where people are very highly bullish about a company, and that's mainly sentiment kind of pushing that stock price up, or they're very negative about a company for whatever reason it is, and that's going to push the stock price down. So that's what kind of determines pricing in the short run. The other thing I talked about was value. What is the value of that company? In other words, what is the intrinsic value? So this is what usually you find when you see analyst reports about a company. What they're trying to do is come up with an intrinsic value. Now, intrinsic value is going to be different for every investor and every type of person trying to invest in this company or this stock. And that's because everybody requires a different type of return. Everybody's willing to take on a different type of risk to achieve that return. But what you're doing essentially with intrinsic valuation is you're looking at the value of that company over time, essentially the cash flows that that company would generate. And as an owner of that company, when you buy the stock, you're entitled to those cash flows. So what those cash flows look like going out into the future, and what are those cash flows worth to you, basically, that's where we come up with an intrinsic valuation. And one of the most common methods of trying to determine intrinsic valuation is a model. And that model is typically discounted cash flow models. Again, what we're trying to do here is take the cash flows of year one, which is next year, year two, the following year, year three, and so on into the future, and then discounting all those cash flows back to today to say, okay, based on a rate of return that I require for this company, I think those cash flows are worth X today. And whether that number is below or above the current stock market price, that gives you an idea of whether you should buy or sell that stock. So last concept we need to kind of discuss in today's video is time. What I mean by this is, like, when you buy a stock, how long are you willing to hold on to that stock to generate the return that's required or what you think is a good stock return? Because as we've kind of discussed earlier, you have unsystematic and systematic risks. So there could be things that happen that are kind of out of your circumstance or out of your power, so to say, that could affect that stock in the short run. The other thing that can happen is pricing, right? Again, the supply demand curves can shift on you, even though the company might be doing well. So a rumor might break out about a company's CEO, for instance. Whether the rumor is true or not, that's probably going to affect the stock price in the short run because sentiment has changed on that stock price. So whenever you try and figure out, hey, what stock do I want to buy? You also have to kind of think about how long are you willing to hold on to that stock? Because some stocks will do well over a 10-year period or a 5-year period, or maybe even a month period. But in between those periods, there might be rough patches. Or conversely, a stock might do well for the next 2 months, and then after that, do terrible for the next 3 years. You just never know. So you always have to kind of go in with that question of, which stock should I buy, with also the understanding of the time frame or the time you're willing to hold on to that stock. Now, my personal belief is trying to time the short run is very, very difficult because I think in the short run, prices of stocks are kind of pushed around by sentiment. Again, that supply demand dynamic that happens. Whereas in the long run, I think the fundamentals end up kind of overcoming the short run sentiment that's happening. Because if a company continues to deliver profits and revenue increases day after day, week after week, month after month, year after year, that's going to catch up, or that's going to be reflected in the stock price. Whereas, again, a rumor or just the stock market in general doing poorly, that's going to affect the stock price in the short run. So whenever you ask this question of yourself, which stock should I buy? Or if somebody else, you come to me and ask me, which stock should I buy? One of the first things I want to ask you is like, well, how long do you have? Like, how long are you going to hold on to that stock? Because that matters.
So clearly I haven't answered your question of which stock you should buy, but what I wanted to do with this video is at least give you some thought process that needs to take place before you even consider that question. In our next video, we'll dive a little bit deeper into the process that I use, again, to answer that question. So until then, make sure you hit the like, subscribe, and hit that notification bell so you get notified when that next video drops. Until then, happy investing. We'll see you soon.